Good day, everyone. Thank you so much for investing your time with us on a Friday. Today, we have an amazing panel where we will talk about emerging trends and opportunities for real estate investing in Africa. Our panel today is a result of Cornell students hoping to stimulate critical conversations with distinguished industry leaders who can share insights, discuss important issues, and offer real estate investment and career advice in the African context. Thank you, Cornell, for supporting our mission to expand the scope of learning. This event was organized by two student groups, the Johnson Africa Business Society, JABS, student organization, which serves as a professional and cultural incubator for Cornellians who have a strong interest in business in Africa, and the Philip Payton Society for Minorities in Real Estate, PPS, which empowers students interested in real estate by providing educational and networking opportunities. Before we begin, I will introduce the programming team and the speakers. My name is Joanne Ingbazo, a 2020 graduate of the Baker Program in Real Estate at the Hotel School. I was a former VP with JABS and of the Association of Cornell Women in Real Estate. I currently work in asset management at Bentall Green Oak in New York City. Hawkins Asidao is a second-year master's in business administration candidate. He is the current vice president of JABS and treasurer for PPS. His career interest is in real estate investment management. Cote Perez is a second-year dual-degree MBA master's in real estate candidate. He is president of Philip Payton Society and founder of Cornell's Coalition for Affordable and Sustainable Housing. His career interest is in real estate development. Ivy Ochieng, one of our moderators for today, is a first-year MBA candidate and president of the Johnson Africa Business Society. Her career interests are in green building and tech solutions. Eugene Afrani, our second moderator, is a first-year real estate candidate. He is editor of the Cornell Real Estate Review and VP of JABS. Upon graduation, he plans to work in real estate equity and debt investments. Finally, I would like to introduce our speakers for this conversation. Bright Owosu Amofa is the CEO of Apollonia City, the largest mixed-use master plan urban development in Ghana, developed by Rendezvous, Africa's largest urban land developer. Mr. Owosu Amofa is a finance and investment professional with experience in real estate, venture capital, private equity, and investment banking across the West African region. He holds an MSc in finance from the University of London, UK, and has completed the Harvard Business School's real estate management program. Hafiz Giwa is managing partner of HC Capital Properties, a privately held real estate investment and development firm based in Abidjan and London. His firm invests in retail, office, hospitality, and multifamily assets across West and Central Africa, including Cameroon, Cote d'Ivoire, and Senegal. Previously, Mr. Gee was an investment principal at Actis, a leading global emerging markets investment firm, and a senior financial IB analyst at Morgan Stanley. He holds a BA in finance from Howard University and an MBA from Harvard Business School. Kafir Rusin is a commercial director at Terrace Africa, a commercial property development company focused on Zambia, Mozambique, and Zimbabwe. He is also managing director at Africa Property Investment API Events, which is the leading event and thought leadership platform in Africa. Kafir is also the founder of Africa PropTech Forum. And finally, we have Tola Akiname. He is an investment banker with specializations in real estate structured finance across West Africa, with experience in an estimated portfolio size of over $1.5 billion. He is also involved in debt capital raising for major infrastructure projects in the oil and gas industry sectors. Okay, I think that is it. Before I hand it off to Ivy and Eugene, a bit of housekeeping. Panelists and moderators, remember we have a 3-minute time allotment for responses, so please keep that in mind so we can get to the Q&A. And finally, to our audience, please participate via the chat box throughout the entire discussion. Ask your questions as we go along, and we will share audience reactions and questions at the end. All right, off to you, Ivy and Eugene.
All right, thank you, Joanne, and thanks for the introduction. To kick this off, I would like us to discuss African real estate on a more macro level. And to do this, I'll start with Kafir. You organize the leading real estate events across the continent. What are some of the trends you are seeing? What are people talking about? What are the emerging players? And what are people doing? Basically, what is happening in the African real estate industry?
Thank you, Eugene, and thank you for also inviting me to speak on this platform. So I think there's been a lot of trends that we've seen, let's say pre-pandemic, which have now just been accelerated. I think there's traditionally the first cycle of investment in African real estate really was geared towards commercial offices, retail, multi-home or residential. And what we're seeing now is a shift of focus toward more logistics and warehousing, to more affordable housing, to student accommodation, and to more asset classes that are really, delivering or more catered to where there's, mass demand. Whereas I think, previously, a lot of the real estate was built for multinational corporates or businesses coming into Africa. What we're seeing now is we're seeing a shift toward where developers and investors are looking to develop real estate that really can be scaled up and really talk to the mass market rather than talking to niche corporates or multinationals coming into Africa. I think those are the key trends. Also, I think we'll talk about some other, we're seeing shifts in the way things are funded, where the capital is coming from. Historically, it's been very much private equity driven. Now we're trying to move that to more local capital, pension funds, etc. So those are certain things that we will see happen. It's still very, on a global scale, it's in its infancy from a real estate sector perspective. So we're still developing the narrative and we're still seeing things unfold. But I definitely do see a shift both from developers and investors, more towards, let's say, your less traditional asset classes versus what was the original asset classes like offices and retail and commercial assets. So those are some of the things we are seeing. And I just believe that the pandemic has just accelerated those trends. It's not anything we didn't know pre-pandemic. And it's definitely going to now be accelerated as we move forward.
Very nice. So Kafir gave us insight into trending projects on the continent. Bright, your company Rendezvous focuses on mega city development projects in Africa. And there's some logistical benefits, financial hurdles associated with these projects. Now, this is a two-part question. Can you speak on the current projects that your company is undertaking? And also, why focus on urban development projects versus smaller-based development projects? Do you see this as the optimal solution for urban development in Africa?
Thanks very much, Ivy. And thanks to you and your team for organizing such a great event. I'm very honored and proud to be a panelist. And I hope that I will be able to share, some of my experiences and that, our listeners will benefit from my experience. So I work for Rendezvous. Rendezvous is currently the largest urban land developer. I look after the Ghana projects where we have two unique projects. We have 7 projects across Sub-Saharan Africa, we operate from, like I said, Ghana, but we have our flagship project in Kenya, where incidentally Ivy comes from, Cote City. We've got Roma Park in Zambia. We have 2 projects in Nigeria as well. Alaro City was launched just about 36 months ago. That has really picked up. It's doing quite well. We have another project in DRC and then in Zambia as well. We were actively, the plan is to be in every sub-Saharan African country, and that's our goal. We obviously at some point we had to slow down just to execute some of these projects. And again, like I said, pre-COVID, a lot of developers have massive expansion drives and objectives to sort of, if I will recap it, really look at some of our expansion plans and, just really focus on execution on the ones that are active. So as I said, I look after the two projects in Ghana, Apollonia City, which is very well advanced, and then King City in Takoradi, which is sort of at the very early stages. That project was conceptualized, and we acquired the land, on the back of Ghana's oil find. But Eugene will probably agree with me that Takoradi hasn't developed at the pace that we all anticipated. And given what's happening in the oil and gas industry, that project we're still trying to relook at the model, right, and come up with, as Kafiri said, most developers, we're having to rethink the way things are done in Africa. You have to innovate and come up with, we believe, products and projects that suit the specific niche markets that we find ourselves in. So maybe I'll just give a very quick overview of Invest. I suppose as we go on, I can expand on some of the things that we do. As I said, we're currently the largest urban land developer. We like to acquire, our sweet spot is about 1,000 hectares of land, just about 20 to 30 kilometers from existing CBDs. We all know the challenges with the cities across Africa. At our last check, there was 52 cities with populations almost in excess of 1 million, and most of these populations are growing very, very rapidly. Our belief is that it's very difficult to fix the current challenges that we have, and so the easiest way is to start new urban communities on the outskirts or on the conurbations of these fast-growing cities. Greenfield site, so that gives us an opportunity to do things properly, start from scratch, and then also benefit from some economies of scale, by investing in infrastructure. So, we acquire these pieces of land. We spend per project typically about $250 million to connect what we call bulk infrastructure, and then we do the internal infrastructure. And then we're very flexible in terms of the products that we come up with and how we operate, once the project becomes live. And so we partner with local developers, we partner with individuals, we do our own development. And again, depending on the jurisdiction or the location of the project, we're also very driven by the market. So we allow the market to dictate and almost inform, as to how we scale, how we face the project or how we finance it. So now I'll leave it. I think this one part of the question. Can you repeat the second part for me, just so it's very clear? It wasn't very clear.
I think the second part was just about if this is the solution, like large-scale mega city developments versus having small building projects in a city. Is it the solution for Africa? Because like you said, you're doing various projects across the continent.
Yeah. Okay, thanks. So I think I may have touched on that. Our belief is that is the solution. It's very difficult to fix some of the existing cities that we have. So it's much easier, to start from scratch, we believe. Because again, if I speak for Accra, and the same happens I've been to Nairobi. I know what the proverbial Nairobi traffic is like. Every morning, you've got millions of people trying to get into the center of town. The same thing happens, during rush hours. We believe that we need to start creating communities or other urban centers which will drive people away from the center, decongest the center. And like I said, greenfield sites give us an opportunity to do things properly, properly and put in the right infrastructure.
Yeah,
it may not necessarily work for every market, but I think that we feel it's certainly the way forward. The government alone cannot fix most of the infrastructure challenges that we have. So as large-scale developers, we feel that is certainly a way forward. And it's much easier to copy and paste the same model across various cities.
Yeah, I do definitely agree with you that the challenges we face with real estate on the continent needs private sector intervention. So absolutely, we need large developers like Rendezvous to step in, which you guys are. But yeah, my next question will be for Hafiz, and it will tie into almost the same question I asked Kafir. Kafir spoke about the trends pre-COVID, and you started your company HC pre-COVID, and you built the mall in Cote d'Ivoire. Can you speak about your journey to this real estate investment? What are some of the trends you noticed that led you to starting this? And was the path you always had in mind, was it what actually, the path you had in mind, was it what actually happened?
Thank you for that. again, as everybody said, I'm really excited to be on here.
I think we might be having some issues. Yeah, we might be having some issues hearing you, Tola.
I had in mind and what.
Okay, yeah, we're just going to move on to the next question. I think he's having some technical issues. So we've heard about projects happening on the continent. Now we're interested to hear about the financing side of things.
It happened.
Are you back with us? Okay. Yeah. So again, we had about various projects happening on the continent. Now I'm interested to hear about the financing side of things. And this question is for Tola. Generally, African developers are very cautious about acquiring local debt. What would you say are contributing factors to the high cost of debt? And how are banks perceiving real estate risk across various asset classes?
All right, thank you very much. And thanks for this panel. I think it's a useful session that just throws light on emerging asset class within the continent. And I think quite a lot of work has been done by many of the people on this panel, just in their various businesses. And I think we're trying to create a real market, and kudos to everyone for even setting this up. And hopefully that begins to change the dial in terms of investment in real estate in Africa. So yeah, from a funding point of view, I think a lot is said about the debt component of the funding, but I think for real estate, I think the first premise is really understanding the capital stack, right? And it differs from continent to continent, and so I think it's then a wrong premise to cater for the understanding based on what you see in other developed markets where there's liquidity. So liquidity is the first thing. So if you compare to other markets like in Europe, in the US, where there is funding, right? And then that changes the dial. So what we're seeing in Africa first is institutional knowledge about the asset class, and really understanding based on the macro indices that we have to contend with, be it interest rate, be it exchange rates, be it rental levels, because we're talking about the macros, and it all boils down to what the returns are, what are the rental cash, what are the income streams that you get from those assets. So those are the macros that begin to morph and shape what the capital stack is. So our experience really in the market is that you tend to fund on a slightly higher debt level. So it could range from 40 to 70%, depending on the asset class, be it retail, be it residential. So there's more equity skin in the game, really, because of several factors: pricing, tenor, and tenor goes to the availability of capital, the right type of capital. So just linking that back to debt. What you've seen traditionally over the last decade is a flight to foreign currency debt, but that also has its impact and issues when there is when there's a devaluation in the currency. But that's what you've seen in the past due to the lower interest yield on dollar funding, and also because the origin of the equity capital that came into those assets are really offshore capital. So there's then that need to match both currency types. But what we're beginning to see is an hybrid situation. And also then the need, and I think I've mentioned it earlier in terms of the macro changes that we're seeing. You're now seeing, given that institutional investors are seeing assets have been created, understanding the cash flow impact, understanding the economic, socioeconomic impact, you're beginning to see those kind of local capital being interested in real estate. So I think it's really understanding the macro element, which makes it slightly difficult for local currency to be priced at single-digit currency. And you need the overall macros to improve, which we're beginning to see. I mean, I'll look at markets such as Ghana, Nigeria, where about a decade, 15 years ago, you had local debt at 30% or more. But I think, I mean, that is after now, and you'd see seeing rates tending towards maybe the mid-teens or higher teens. But I mean, that is still high compared to single-digit dollar funding. So I think those are the real metrics, and that then speaks to what the capital stack is and how you're able to fund and structure debt deals. I hope that provides some background.
Yeah, that's very insightful, Tola. That's very insightful. I wanted to go back to Hafiz just to answer the question, and we could then take it from there. The question was, can you tell us about your journey to starting your own real estate investment and development firm? Was this the path you always had in mind?
Pardon the interruption, guys, so forgive me. This was the path I had in mind. So my business school application essay was effectively, my plan or my vision is to start a real estate investment firm, because I saw, the impact it had. My mom was in construction, my dad is a civil engineer. And so my vision was always to start this. And so, applying to business school, as a number of you guys have done, you have to kind of think big. So that was what I thought. I did realize I needed the tools. So I'd come from Morgan Stanley, tried to do a deal in Nigeria when I was at Morgan Stanley, but knew I kind of needed more local expertise. After business school, I joined Actis. And, the day I resigned from Actis, I effectively gave them that business school essay, kind of articulating that this was my plan all along. Now, my journey and what I expected versus reality were two very different things, right? So you're working with Morgan Stanley where they're doing multi-billion-dollar transactions, or you're at an Actis where they're doing, transactions that are in the hundreds of millions. What my experience in starting my own firm, we had to go much smaller. I started it with a friend also from business school. And the journey, I'll say, has been a lot more rewarding than I expected, because we've been able to see the impact, our investment has had on lives. We've created jobs, we've hired people. So it kind of goes beyond, the things that business schools make you think, in terms of doing multi-billion-dollar transactions and things like that. And as Ivy, as I'm sure will say, given her background as an architect, when you create infrastructure, you kind of really change the landscape. And so those are some of the things that in this journey have kind of helped me kind of stay motivated and really excited about what I'm doing. So I think as Joanne said, we're active across West and Central Africa. But I'm in Lagos, and I'm responsible for, transactions in Nigeria and a number of the Anglophone markets. So that, I hope that gives a little bit of context. I know we'll get into more detail, but the journey has been in a way similar to what I imagined. But I thought there would be a lot more zeros and things like that.
That's very interesting. You just given us, I know there are a lot of students on this call, MBA students, and students in general. So it's very insightful because at the end of the day, we all want to go back to the continent to invest, apply our skills and all of that. And there was one trick. Take your MBA application to your employer as a way of resigning, because you tell the good African story during those MBA applications. That's a good one. But my next question goes to Bright. Speaking about financing, Rendezvous is backed by American, Norwegian, British, and New Zealand investors. What criteria for partnership are foreign investors looking for in Africa? Are there any particular return hurdles?
Thanks, Eugene. But I guess let me say that I think it depends. It will depend on the type of real estate, the type of real estate asset class that investors are interested in, or the type of projects, because there are various types of projects in real estate, in particular when it comes to Africa as well. For Endeavor, as an example, I think Tola mentioned we mentioned financing briefly, but one of the challenges, particularly for developers or for projects across Africa, when it comes to real estate, is really financing. Because on the continent, it's very difficult to get any form of long-term capital, and we all know that in real estate, you do need some form of long-term capital. Local banks tend to do very short-term tenors, high interest rates. As Tola said, the trend seems to be coming down, but I think it's still nowhere near where ideally we want it to be. And so, one of the ways that work successfully in Endeavor, for instance, have implemented is by, essentially going to, it's almost like a family office type of model or high net worth individuals. And so if you look at our funding structure, there are really quite a number of high net worth individuals who have pooled their own capital, personal capital together into a vehicle, or let's say private fund, let's call it that way, Endeavor. So Endeavor itself, which is why most of our projects are quite unique in that, locally the capital structure of the funding structure is quite unique for every particular project. But the Endeavor vehicle was created where individuals from New Zealand, Stephen Jennings, who is our founder and lead investor, is an American. Thorsten Hagen is a Norwegian. Simon Edwards, British. So all of these individuals have put money into that vehicle very long term, fortunately for us, because the way our model works, we really can't use debt, particularly to finance infrastructure on land. And so we needed to come up with a model like that, which is more long term. Obviously, most investors will certainly have a return expectation. And as I said, it will depend on a particular project and its own risk profile, or depend on the type of project that it is. But for us, projects are extremely long term. Every project, typically, we're talking about 20-year cycle. All right, so our projects are very scale. The cost, heavy infrastructure costs are upfront, so that's front loaded. But if you look at our model, after year 10, we're really essentially sort of trying to almost printing money, because a lot of the infrastructure has already gone in. And once you start selling and you cash flow positive, you start to recycle a lot of that cash back into the project, right? And so again, plus because for us, we're in several markets, as I said, we're in DRC. The risk profile in DRC probably a little bit higher than a risk profile in Ghana. And so you've got to see a different sort of return expectation for a Ghana project. Same for what you would have in Kenya. As I speak, when I speak about Kenya, I speak very positively because there's been a lot of, institutional change. I think the Kenyan government has made, for instance, doing business quite a lot more easier if you compare to most of the markets that we're in. And I think in Kenya too, you can actually find, in terms of all the markets that we are in, I think that's probably where you find the cheapest local debt as well. And you can borrow, on the shilling, you can get somewhere around 12, 13, 14. Some banks are doing that. Whereas in Ghana, Nigeria, it might be difficult to find that kind of pricing, if you go for that, right? So I guess I'm not trying to dodge your question, Eugene. What I'm saying is that, the return expectation would depend on the specific projects. In our case, very long term. So we are not a typical a PE model where you're looking to, go in and out in 7-8 years. And so you have a certain fixed hurdle rate. We're very long term in our thinking, but after year 10, you're sort of practically starting to print money because a lot of the cost has already gone in. Yeah. So I hope that answers your question, Eugene.
Thank you. And you sort of started answering the next question I was going to ask, Kafir. Speaking of capital markets, based on your experience and exposure, what capital markets are currently accessible and most important for Africa? And what is needed to take them to the next level? So is it government support, improvements in tech, sort of like Bright was mentioning? What are your thoughts, Kafir?
Thank you. So maybe just to harp on some things that Tola mentioned and Bright mentioned, I think the original cycle was very private equity driven, and it had quite a short time horizon in terms of when investors expected their returns. So from a capital markets perspective, I think we need to start looking at capital that is more long-term and is more suited to African volatility, to the cycles of African real estate development, which are a lot longer than what we see in the global markets. So I think from a capital market perspective, I definitely want to see, and I said it earlier, I think we need to start seeing institutional capital at a local level. We need to start getting pension funds involved, insurance, sovereign wealth funds, and to unlock that, we need regulation to help unlock that. But we also, as an industry, need to start creating the vehicles that these institutional investors can invest in. It's too risky, in my opinion, to put public money into private equity models right now in African real estate. And therefore, we need to work toward REIT-type models and listed real estate models that allow for institutional capital to go into that. The other hurdle to that is, by default, African real estate has been very non-transparent. There's a lack of data. And when you're trying to get institutional capital, it needs to be backed by data. It needs to be backed by historic returns, etc. So we've got a lot of work to do as a continent to really get the type of vehicles right, to get the data right, to build track records and success stories across different real estate sectors, and also then create volume. If we create portfolios of good assets that can then be rolled into a certain fund or vehicle, then we'll start to see the really the unlocking of capital markets. Bright mentioned high net worth individuals, so I think those are the type of things that we need to start working toward. We need to start working toward capital that matches Africa risk, capital that matches the tenure of these and the volatility. And a lot of the local capital, and I keep on saying local capital, they understand local risk, they understand the government cycles, they understand or are willing to wait longer and understand local current and are able to take local currency positions, which international investors are investing US dollars. And when they come into these markets, there's this huge risk of local currency depreciation. Which maybe local institutional capital can, they can kind of understand it. Yes, ideally they would be wanting to see a US dollar return, but they would understand and be willing to invest in local currency. So I hope that answers the question. We need to move toward getting those institutions and that type of funding from a capital market perspective. But that requires regulation, it requires data, and it requires creating the right vehicles and assets for these institutions to invest in.
Right. That makes a lot of sense on how our African capital markets needs to be be positioned where it kind of assess African risk. So I do really agree with you on that. But even talking about capital markets, we saw globally the capital markets come to a stop when COVID started last year. And this question goes to Tola. Were there any delinquencies occurring in the market, and did you have to give any forbearance? What is your expectation of the debt capital markets post-COVID?
Thank you. 2020 was a very interesting year, is what I would say. But yeah, I think we all have to understand that real estate is long-term, is cyclical. You and as stakeholders, either as equity participant or debt providers, one needs to understand the local markets, understand the tenancy profiles, the cash flows, the currency mismatches that may even appear. And what we saw was it kind of differed across various markets. And then you also saw the recovery also differ across various markets as well. So I think the experience in Africa would also slightly differ from other global markets. Whereas if we consider retail, for example, there's still a depth of retail facilities, and while e-commerce is picking up, there's still that need to go to the local stores. So I think for retail, you saw a slightly quicker recovery in terms of footfalls and in terms of shoppers going back to the facilities. But I think speaking directly to what you asked, you saw landlords providing concessions, and that wasn't the case in the office space, because office tenants are more resident and they pay long term. You saw more of that within the retail. I'll keep it to those two elements. But as financiers, having understood that, you work with your developers, with your sponsors, to understand what the real cash flows are at that moment, and provide structures to support them through that. And as a key financier in the market, we did just that, and provided for variances structurally. And I think that's where the premise is. So it's not about just providing the forbearance for on payments, and understanding what concessions were provided by the sponsors, and working with and so just broadly speaking, we would always evaluate the cash flows, would always to the extent that assets are long lead, you would provide the forbearance and the structures to enable the asset thrive. And what we're then seeing is with the recovery happening, we're then seeing the market evolving, from single type assets to now creating portfolio structures. What those portfolio structures allow you to do is to have cross-collateralization benefits where you're not stressed on single assets. So you've seen the funding dynamics change and evolve, not just from a single asset view, but now looking at this company, this asset as a pool of assets. And where that leads to is then begin to create a new market, where you can begin to also go to the capital markets, either for debt capital or then listing as REITs. So I think that broadly summarizes what we saw last year, and hope that provides some context.
Yes, it does. And speaking of hard times, and this goes prior to even the pandemic, we've been hearing in the news that brick and mortar retail is dead. There are lots of closed malls across America, making this asset class very risky. However, in 2018, Hafiz, you completed a development project, the Cosmos Shopping Center in Cote d'Ivoire. Can you tell us about that project and your reasons for undertaking? Do you see retail as a growing industry in Cote d'Ivoire?
Yes, I do. And I think, we always get this question, which is international investors that have exposure to the US and a lot of the other developed markets where retail penetration is in the 80s and 80-90%. When you look at where we are and e-commerce is making quite a significant impact in addition to that retail penetration, when you look at where we are across kind of sub-Saharan Africa, retail penetration is less than 10%. It's closer to 5%. So that's the first thing. I think when we set off to invest in retail in the Francophone markets, we took a very data-driven approach. So Sheikh, who kind of leads the efforts in Francophone West Africa, is from Cote d'Ivoire. So there was a detailed and deep understanding of that market already. But I think the most important thing was we heavily researched what was needed in the market. Our investment is in the largest municipality of Abidjan, which is the commercial capital of the country. And, in a catchment area of over 1 million people, there was no retail, right? There was no formal retail. So you kind of had the mom and pops, things that weren't properly structured, wasn't safe, wasn't hygienic, etc. And so us going into that market was, first of all, understanding that this is a very large catchment area and it's the largest municipality. And then we also went deeper to understand what the spend was in that area. So at the time of our investment, I think the analysis showed that there was over 400 million euros of FMCG spend, right? So these guys are already buying groceries, they're already buying the fridge, they're already buying things like that. So our decision to invest in the mall in that part of the city was based on what we saw as the trends. In addition, we set out to kind of understand how this differentiates from other parts of the city, right? So if I use New York as an example, New York City, right? So imagine a lot of the developers were making investments in Manhattan, and they wouldn't look at other boroughs like Brooklyn or the Bronx or Queens. And so our approach was effectively going against the grain and also becoming a dominant center there. The third thing, though, that we also focused on was we weren't creating a fashion mall. We weren't creating a mall that was anchored by, the likes of a Macy's or one of those. We were creating a mall that was anchored by a grocer. So Carrefour, one of the largest retailers in the world. In addition, the tenant and the mix of tenants in the mall was based on necessity. So we had a lot of pharmacies, we have banks, we have telcos, we even had a clinic. And so this then takes me to where, in 2018, things were going much better than we expected. Every day we were having about 12,000 visitors. And this and it remains the most visited mall in the country. Now, as a result of the investment and the positioning of the mall, during the pandemic, when the country went into lockdown, we remained open. Now, we had to close down the cinema, we had to close down the kids' play area, but we had a grocer in there, we had a clinic in there, and, the food court remained open for takeout and delivery. And so, from 12,000 people a day at the height of the pandemic, we went to about 12,000 a week, right? But what's happened now, so I was just in Abidjan over the Easter holiday, what's happened now is those numbers have started to come back up. The Wednesday and Thursday before Easter, we were about 11,000 visitors. And so I think this speaks to how you're positioning retail in the markets. We're not there where, Amazon or Jumia or any of these e-commerce platforms have really penetrated. And people still are, at least in our experience, people are still finding that they want to go and experience retail in like a unique setting. Obviously, design impacts how people feel when they come there. We kind of designed this to have a very African look and feel. The name of the mall is Cosmos Yopobong, so the people of the catchment area already felt an ownership. So those things, I think, make a difference. And Sheikh we're doing more investments in retail because our tenants, Carrefour and the rest, they want to kind of come along with us. Because they've seen how our positioning is actually helping with their turnover.
Good.
Is that helpful, Ivy?
Yeah. Yeah, that's very helpful. That is very helpful. Yeah, so I would want us to move quickly into the Q&A session because we have so many questions coming in. And how this will go is that I would read the question out, and maybe one or two of our panelists can take a stab at it for a minute so that we can go through a lot of questions, because we do have a lot of questions coming in. So the first question is from Sherwood, and it says, what African country is best positioned to take advantage of post-COVID-19 economic upturn in hospitality or tourism development? And what hotel asset class, i.e. luxury, upscale luxury, or mid-scale luxury, do you believe would perform best? Kafia, do you want to take a stab at it?
Well, no one's answering, but yeah, I think it's difficult to say which country per se. I think it's a very difficult. I mean, obviously, hospitality was impacted, severely, and continues to be impacted severely because of the pandemic. Tourism, I was reading, some recent data. I mean, I think it's a $20-30 billion a year or even more, industry for Africa. So obviously, and a lot of that is driven by wildlife tourism, etc. So obviously, tourism is segmented. I'm not a tourism expert or hospitality asset expert, but my opinion is that I do think that there will be an increase in local tourism. I believe countries where there's good local tourism spots like Kenya, where there's obviously a lot of local tourism which can now happen. Places like Zambia as well, also driven by wildlife tourism as well, and countries like that, Zambia, Botswana. I think those are the kind of countries that have really unique places and offerings from a local tourism perspective, and that's more on a leisure side. From a business side of things, I do think that there needs to be a focus on mid-level or mid-range type of hospitality assets. So more budget hotels, for regional and local travel. I think what happens, and I think everyone on this panel can attest to it, is you tend to find you've got your big brands, your Radissons, your Marriotts, etc. when you go into these cities, and it's very difficult to find, mid-tier budget hotels. And I think those are more sustainable. And, I think those will, if I was investing in the sector, that's where I would be looking. I hope that answers some of it.
Yeah, it does.
Does anyone else want to chime in before I go to the next question? Okay.
Probably my neck out. Okay. I was going to say something my neck out. Maybe I'm a little bit biased. I know Kafir was being a little more diplomatic. But I think Ghana is certainly one to watch. Kenya too. Why do I say that? Pre-COVID, I think most of us probably had about the year of return. The year before COVID, there were a lot of visitors to Ghana. And that has sort of created, especially from Americans, a lot of African Americans, a lot of, let's say, Black people that are looking to sort of, visit the motherland, as they call it. And so for me, the countries that are going to benefit are countries that take some of these things seriously. Because where do tourists want? Because for you, people in these jurisdictions, and then developers and investors will now start taking a cue from that, and then looking at some of these opportunities, right? Kenya, like I said, it's always been a very good hub. It's got good hotels there, safaris, there are places to visit, and apart from that, also countries that make it easier for people to visit. And again, I mentioned Ghana simply because I think this year or last year I was reading a report where Cote International Airport was adjudged as the best airport in Africa. Quite invested about $145 million in the new terminal. Fairly easy, very quick to get into, Accra, and it's beautiful. It's one of the first things that people see and tourists see when they come into a country. But aside that, most of these markets, I think Afia touched, hit the nail right on the head. The hotel, for instance, is still quite expensive, very pricey. And so, again, if I was investing, I'll be looking at sort of the budget, sort of mid-tier range, because hotels in these markets are relatively very expensive compared to, what you find in, let's say, in New York or some of the, developed countries. Again, just to summarize, I always take my neck out, say, Ghana, Kenya, definitely two markets to watch in terms of hospitality and tourism post-COVID.
Well said. I totally agree. Kenya's the place to go. So the next question is from Kenneth, and I think it's a great question. Are local governments in Africa promoting real estate investment?
Yeah, I'll take a stab at that. I think, I would think rightly so. To separate housing and real estate, commercial real estate. But I do think, that in recently, the government has been beginning to see the contribution of real estate and construction industry to GDP. So that is beginning to stand out. And, haven't seen some of the capital investments that and the kind of assets that have been created over time. I think as an asset class, there's a greater understanding that is coming. So like I mentioned, there are two layers to it in terms of housing. That's where you'll find government is traditionally focused on trying to create affordable housing and trying to ensure that homes are provided for the needy. But if I'll talk about more from a regulatory point of view, we're going to see, government support in terms of the REIT legislation that's also coming. Key markets. If we use Kenya, Ghana, Nigeria, and SLD already as a thriving REIT market, those are regulatory nuances where you have to do quite a lot to get the tax passed through and then set up the legislation to allow that asset class. So from that trajectory, there is support. There's quite a lot of orders in each market, but given the role that real estate plays, there has to then be continuous engagement by the private sector, with the public sector, and working with them to knock or to evolve some of the bottlenecks. The KEF has done, some of the leading real estate conferences. And in those conferences, there's always that engagement, both on the public side and on the private side, and there's that. It's a slow wind, but I would think, given the value that the asset class brings, there is interest, that has been recognized, but it's gradually a slow wind, but we're beginning to see some of those shift and the support coming through.
Yeah, I would. Okay, you could chime in, but we are quite pressed on time, so you could do it. If you could do it within a minute,
I'll do it in less than a minute. But I think it's important to also single out the Ivorian government. They have been extremely focused on, getting FDI into the country. One of the sectors they focused on the commercial real estate side was retail, because of the impact on, changing landscape, changing infrastructure, and job creation. And, they set out a number of incentives around tax exemptions from import duty exemptions and tax holidays. And so that, when you're making an investment decision, really helps. And so I'd say that is one country that, at least in my recent experience, has really looked to make the investment opportunity a lot more attractive.
Right. Thanks for that. I would want to read this as the last question because we just barely have a few more minutes to end. So this question, I think all of you can take a stab at it because I think it's a good question. It's from Rich. Is there any opportunity for an individual investor to participate? And if so, can one get more detailed information?
Hafiz, do you want to go for that?
Absolutely. There's always an opportunity. But I think it depends, one, on what the person is looking to get out of this, right? So if you look at all the groups that are already invested in sub-Saharan Africa, a number of them have had the returns exceed their expectations, and most of them are doubling down in terms of continuing to invest. So if this is a family office or, a high net worth individual, absolutely. But, in markets like Nigeria and Cote d'Ivoire, there are not many REITs where you can kind of take advantage of the sector and the growth in the market. There are more private players, but then it becomes just making sure you understand who your partners are and their ability to execute.
Yeah, I think the only contribution I'll make to that, I don't know if you can hear me. One needs to better understand when you're talking about the individual investors, then scale to what type of investment this is and what size. I think those are the parameters. But if as a student, if as a young person you're starting out, I think there is investment opportunity across the various markets, across the various asset classes as well. I mean, we've talked about, I think early on when Kev gave some of the macro, you've seen a shift from the traditional retail offices, which may be more big ticketed, to student housing, to residential, to logistics, to other sectors that may be low ticket entry levels. But at the end of the day, real estate is also food. It's best if you invest in a market you're not familiar with, then you're selecting the right partner. Going through a joint venture approach. To the extent you're an HNI, there are all those that due diligence to do and to go through. But I think the opportunities are so immense and it's looking for capital. Thank you.
Right. We wouldn't be able to go through the remaining questions we have from our audience. So I would pass on the stage to Hawkins, who would close us out and maybe ask for the last words of the speakers.
Right. Thank you. My name is Hawkins Etidao, and I'm the Vice President of the Johnson Africa Business Society and Treasurer of the Philip Payton Society for Minority Real Estate Professionals. I would say that this has been a very enjoyable session. Thank you to all our panelists, Bright Owusu Amufa, Tola Akinami, Kafir Rusin, and Hafiz Giwa. Thank you to our moderators, Ivy Ocheng and Eugene Afrani, and to the rest of our program committee, Cody Perez and Joanne Angbazo. This event has been organized by the Johnson Africa Business Society and the Philip Payton Society for Minority Real Estate Professionals. The Johnson Africa Business Society is an organization that serves as a professional and cultural incubator for Cornellians who have a strong interest in business in Africa. Follow the Johnson Africa Business Society on Instagram at JABS, JABS at Cornell to keep informed of future events. The Philip Payton Society for Minority Real Estate Professionals is to create a sense of community for minority students interested in real estate and to provide them with educational and networking opportunities. Please join the Philip Payton Society through the Cornell campus groups. We have had a global audience from New York to California to Lagos to Nairobi. Thank you for attending this event, and this brings us to the end of our event. Thank you, everyone. Asante sana. Have a great weekend.
Thank you. Bye-bye.
Bye.